Hello and welcome everyone to another market commentary from us at StashAway. With us, of course, our CIO, Freddy. Hey, Freddy.
Hi guys, good to see you again, Philip. It's been a while.
Hey, Stephanie. How are you?
I'm great, thank you.
I'm good. I'm good. Of course, turbulent times right now. So we don't want to, wait too long. It's been, I think, 2 weeks since the last video, and I wasn't in that one, but I know we touched on some early sanctions. But the last 2 weeks, everything has quickly escalated, Freddy. So do you want to give it a little bit of a update first on kind of what has happened so far over the last 2 weeks with the war in the Ukraine? Going into the next phases. Just for the listeners to get a little bit of overview and what your take is on that.
Well, if you take a step back, the U.S. were very early in warning the world that it is very likely the Russian military would invade Ukraine. And that warning led to a delay by a week that eventually happened, but it delayed by a week. Now, what comes after, amid all the, of course, it's tragic and it's traumatic to see warfare. So we feel for the families, and there's been a lot of refugee movement to the likes of Poland and all. But in terms of for financial markets, the focus was on the huge impact of on energy prices, not because of supply disruptions when there's warfare, but more so about sanctions that's going to be more severe. As you knew, a lot of quite a number of Russian banks are now kicked out of the SWIFT banking messaging system. They didn't do Gazprom Bank, which sort of there's the nuclear option. When you do that, effectively you're not importing or able to trade with Russia on their energy and gas products anymore, which is a huge deal for Europe. Even the US imports from Russia to a certain extent. If you count oil, gas, and all the peripheral, 8% of US energy inputs from Russia. So it is significant. And as of now, it's official that the US has unilaterally banned the import of Russian gas and energies. Canada has joined in. Customarily, because it didn't matter. Canada is self-sufficient, but they did it anyway. UK has joined in, but the rest of Europe has not and could not. Either way, oil price now trading at $128. That's the main impact on it. Could go as high as 150, according to a lot of analysts. If you look at Gulf War and the past events, maybe it could go to 150. But the impact on consumer inflation is real.
Absolutely real. Like I told you both before the show, I think I was on a 2-week trip to Europe. I left and I think I paid $3.50 per gallon of gas. I came back to over $7 today. So definitely real, right? And if something like this doubles and your income doesn't, then it's getting quite painful in your own personal wallet, right? So how
well, it's going to start showing at the pumps for sure, Philip. But also, I just want to remind ourselves that we've been preparing for a more momentous inflation anyway. Since July last year, we did it again. We did another reoptimization in January to maintain the effectiveness of those protection, and actually has served us very well this year, creating a lot of resilience for our portfolios. Topic for another time, but just want to highlight that as well.
No, absolutely, and I appreciate you highlighting this. With that being said, we're supposed to be really close to a rate hike coming, right? That has been announced already a little while back and supposed to kick in this month. Stephanie, what are your thoughts on the Federal Reserve strategy going forward? Right, they're battling, high inflation on one side. There's geopolitical risk now, even more accelerated than the last meeting that they had, right? Where do you see this going, and how will it affect stocks?
Yeah, I mean, the Fed meeting is upon us, is on the 15th to 16th. So very, very soon we'll actually get the historical first hike in this rate cycle. Powell previously has already indicated that they will raise 25 basis points at this meeting. So the rate hike should not come at anybody's surprise. I think what's key is how to indicate whether the war in Ukraine and also all the economic sanctions have, and also, of course, energy prices will be impacting their view of inflation and also growth going forward. I mean, to be very frank, I think the Fed is actually in a very, very hard place right now because on the one side, you have inflation soaring to multi-year highs, not just headline inflation, which has been reading 7.5%, but also if you drill a little bit deeper, the core inflation, which is really what the Fed is concerned about, core meaning excluding oil and food. Core inflation is also rising very rapidly in the scale of 6% in the last reading. So this is way, way, way higher than what the Fed is comfortable with. They've indicated they're okay with on average, about 2% inflation. So even if you take like the upper range, maybe 3%, I mean, this is still way higher than that. So the Fed will have their hands tied because high inflation means that they need to tighten monetary policy and to reverse some of the loosening and all the QE expansion they've done since COVID. On the other side of the equation is what they need to be thinking about is employment and growth. Here, the current numbers are still showing very, very strong, i.e. unemployment rate is still very low, non-farm payrolls is still very strong. And if you look at some of the coincidental growth numbers, they're also very strong. The problem is that if you think forward, if let's say energy prices continue to be sustained at a high level because of the, I guess, longer economic impact, or if we're talking about, U.S. ratcheting up sanctions, if energy prices stay high, eventually it'll bite into the consumers' pockets and how much they can spend, and that eventually filters back into lower growth for the economy. So again, I mean, the Fed depends on how forward the Fed looks at this, and given the uncertainty of the nature of the war, it's a hard place for them to be.
No, absolutely, and I think Freddy as well, and Stephanie, the markets never like uncertainty, right? And we're seeing that, right? With I think it's four consecutive weeks all the way down, right? Or a little bit more than that, actually. And some sharp movements in terms of volatility, right? We're having negative 3% days. What are you going to say to listeners and investors out there that are concerned about their portfolios? And what would be your game plan in terms of that, right? Like, what should they do?
Well, at this point, if you do it at this point, you're late. So as you knew, we've been preparing for high inflation. Obviously, we didn't forecast that Russia would invade Ukraine. Not possible. We're not fortune tellers. But by the numbers, if you're seeing a high inflation momentum, you start protecting your portfolios preemptively. So July, we have done it. In January this year, we've done it again. And I'm very pleased to tell users that our portfolio, for example, in Singapore terms, year to date, actually we have one of some of the lower risk portfolios up 1.2% before fees and dividend taxes and tax reclaims, and the worst performing ones around minus 3.9, the highest risk portfolio. But when you compare that against the broader market, the big benchmarks such as MSCI were, and they're down in Singapore terms nearly 12% and 13% in US dollar terms. That's a lot of stress. And in relation to that, our measure that we have done twice before this happened has created a lot of resilience and lesser correlations to the general market turbulences. So we no complacencies. We continue to monitor the situation, but a systematic, economically driven approach and something that respect valuation opportunities in the market is sort of what StashAway has been doing for the last 4.5 years, and we'll continue to be very focused on that.
Great. Thanks, Freddy. And last but not least, we did get a few questions from listeners as well. And I wanted to highlight one of them because obviously it's, of course, going towards this Russia-Ukraine situation. And it's with the current sanctions on Russia, does StashAway portfolios have any Russia stock or bond holdings in them?
Actually, not at all. There's probably one or two risk point on the entire platform with 0.4% maximum. in sort of exposure. So it's negligible. You shouldn't have to worry. It is very, very insignificant for us.
Great, Freddy. And then last but not least, a question that we get quite a bit in recent times is, hey, is this now, if I had some cash, right? Or if I had some cash laying around, would this be a good time to just deploy that already now? Would you still suggest dollar cost averaging at this point, Freddy or Stephanie? What would kind of be your take if someone comes to you and asks you for advice on deploying some money?
Yeah, I mean, obviously, if you look at asset prices, as Freddy has pointed out, I mean, MSCI World is down 12% year to date. I mean, that is historically, I guess, a medium-sized correction. So I mean, things have been priced in to a certain extent, but also markets will remain quite volatile. Like it will react to headline news every day. So as a long-term investor, what we've always advocated is that, I mean, if you keep reacting to headline news, that's not the sustainable way to invest. And of course, I mean, market corrections like these create good long-term investment opportunities, but also make use of tools like what Philipp has mentioned. DCA is a very, very good tool. Dollar cost averaging, just kind of divide up your capital into tranches and take advantage of these market volatilities instead of letting volatilities take advantage of you.
I also want to highlight that our strategies are differentiated. We prepare for inflation. We created resilience this year. So I felt like that reduces a lot of the noise to your portfolios. So there's even more reason to be systematic to your plans that you have set for yourself long term. The old famous saying, "This too shall pass." But by the time you retire, 30 years, 40 years from now, you got to compound. And at this moment, like Stephanie said, some may view it as a way to enter the market cheaper and average in. That's a long-term perspective. But the additional benefit is that a differentiated investment strategy would provide additional protection too. So we also got to think about that. So definitely stick true to your long-term plans.
Absolutely. Thank you, both of you. And last but not least, for all the listeners, we do have a few events coming up that you can sign up for. And the first one is actually across pretty much most of our markets, which is Singapore, Malaysia, Hong Kong, and the MENA region. We have an event with BlackRock, and it's called What's Next for ESG Investing. So that's on Tuesday, the 15th of March. That's 3 p.m. Gulf State time and 7 p.m. Singapore, Malaysia, and Hong Kong time. And for Malaysia, we have a separate event as well. That's Personal Finance Basics. That's Wednesday, 16th March, 6 p.m. local time. As always, if you want to listen to those and sign up for those, there will be links in the show notes below, as well as on our website and anywhere else you can connect with us. With that being said, thanks both of you so much for being here today again. And all the listeners, thank you for listening. Keep your questions coming. Always feel free to reach out to us and our customer experience team as well. Until then, bye-bye. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.